Hello guys, this is Anurag Sharma again, and today I'll be discussing with you in the series of understanding the functions of Reserve Bank of India, the monetary policy of India, part 2. It is prepared by me, Anurag Sharma. So let's understand what is the various instruments for credit control under monetary policy. Guys, in my previous chapter, I have clarified what is the meaning of monetary policy, and basically, in a nutshell, it can be said that monetary policy is the regulation on the circulation of money and credit supply. So circulation of money I have discussed in my first lesson, and now in this particular lesson I'll be discussing with you the flow of credit in the economy. And control of credit is one of the most important objective of monetary policy of our country. And control of credit means increase or decrease of the flow of credit in the economy in accordance with its needs. Increase or decrease, I'll be saying these two terms as contraction or expansion. Contraction means decrease and expansion means increase in the credit control. So what are the various instruments of credit control? Broadly, we can divide all these instruments of credit control into two broad categories. One category is known as quantitative credit control instruments, and the other policy is known as, or other instrument is known as, qualitative or selective credit control policy. In this particular lesson, I will be discussing with you the quantitative credit control instruments of monetary policy. So what is quantitative credit control, guys? Quantitative credit control is non-discriminatory in nature, and when I say non-discriminatory means it puts an equal influence on all sectors or products. So there is no discrimination in case of sector or products. It puts an equal impact, so that's why it is a non-discriminatory instrument control. And the basic purpose or the basic objective of quantitative credit control is to control the total quantum of credit. So total quantum of credit and credit created by public bank or private bank. And these are the following instruments of quantitative nature of credit control. And guys, let me make this point very clear that these terms are very important in all the competitive examination of any financial institution or any economics related examination. So put all your concentration on understanding of these terms. So the various quantitative nature of credit control instruments are: number one is bank rate, then comes your statutory liquidity ratio, in short we call it as SLR, then open market operations, cash reserve ratio, repo and reverse repo rate. So I'll be discussing with you these terms one by one. First of all, bank rate. Bank rate, it is also known as discount rate. And what is that discount rate? It is the rate at which RBI discounts or rediscounts the bills of commercial banks. Suppose commercial banks needs any any amount of money, any amount of cash, or any amount of what these commercial banks will do, these commercial banks will give their bills. These bills are known as bills of exchange, and these bills will these commercial banks will give these bills to Reserve Bank of India, and Reserve Bank of India will discount or rediscount, whatever the case may be, these bills on a particular rate, and that rate is known as bank rate. Now how this bank rate influences the quantum of credit? Now remember this thing, guys: higher the bank rate will contract credit in the economy, because it will lead to decline demand of loan and vice versa. Whenever there will be increase in bank rate, guys, so it will lead to increase in interest rate on loans, and whenever there will be increase in interest rate on loans, so definitely it will lead to decline in demand of loan, and it will lead to contraction of credit, right guys? And it is a long term concept. When commercial banks take loans from RBI for more than a year or so, so then at that rate, discounting and rediscounting of the bill takes place. That particular rate is known as bank rate, right guys? Now next, move to our next instrument. It is known as SLR, or statutory liquidity ratio. Again, an important term and important instruments of monetary policy to control the quantum of credit. Now what is SLR? SLR is a certain percentage of deposits is to be kept by banks in the form of liquid assets. Apologies for the spelling mistakes. Is to be kept by banks in the form of liquid assets, and it is kept by banks itself. Now liquid assets is in simple terms, liquid assets can be any asset which can be easily easily converted into cash. And liquid assets over here includes any government security, treasury bill, or any other securities which is notified by Reserve Bank of India under the category of liquid assets is known as these liquid assets, and it is kept by bank itself. And more of the SLR will have the less surplus fund for granting loans, and it will lead to credit contraction, and vice versa. Means more the SLR, there will be more credit contraction. Less SLR means there will be more credit expansion, right? So our next instrument is to control the quantum of credit. It is known as open market operations. And what is open market operation? It means RBI controls the flow of credit through the sale and purchase of securities in open market. RBI actively participate in the sale and purchase of securities in open market. Now what it will do? Whenever there RBI will purchase securities, so it is making payment to commercial banks and public banks. It will increase the circulation of money, so there will be expansion, and it will further expand the credit in the economy that I just mentioned. And when securities are sold by commercial bank, then public and commercial banks make payment to RBI, because now central bank is buying securities, so that's why there will be public and commercial banks make payment to RBI, and that's why they are less with less money. They are left with less money, and credit creation capacity is reduced. So this particular, when RBI actively is participating in the sale and purchase of securities in open market, that instrument is known as open market operation, purchasing of securities and buying of securities. Then comes our cash reserve ratio, very important instrument guys. Cash reserve ratio, CRR, and Reserve Bank controls the cash reserve ratio of commercial banks. RBI is authorized to implement these CRRs to all the banks, be it any private bank or a public sector bank, and it is obligatory for commercial banks to maintain this ratio. Now what is CRR? Very important guys. Now CRR is minimum cash reserve that every bank has to maintain with RBI. It is the minimum cash reserve which has to be maintained by every bank with RBI. So whenever there will be increase in CRR, it will lead to credit contraction, because more of the money will be maintained with the RBI. And whenever there will be decrease in CRR, it will lead to surplus funds for commercial banks. So it will lead to the credit expansion. So more the CRR, more will be the credit contraction, and less the CRR, there will be credit expansion, right guys? So basic difference between SLR and CRR is that in SLR, whatever the liquid assets have to be maintained, it has to be maintained by the bank itself. But in CRR, that minimum cash reserve that every bank has to maintain, it has to be maintained with RBI. So this is the basic difference between statutory liquidity ratio and CRR. Apart from that, in SLR, the assets, whatever the amount is to be maintained, it is to be maintained in liquid assets. Now extremely important rates guys, extremely important: repo rate and reverse repo rate. Repo rate is repurchase auction rate, and reverse repo rate means reverse repurchase auction rates, and these are the main monetary policy rates. What is repo rate? The repo rate means the interest rate at which commercial banks can borrow funds from RBI. Right guys, I'm repeating again. Interest rate at which commercial banks can borrow funds from RBI, that particular rate is known as repo rate, and its reverse will be reverse repo rate. It means the interest rate given by RBI on deposit made by commercial banks with it. Now how these two rates will influence the credit contraction and expansion? Whatever the rate is, whether it be either it is repo rate and reverse repo rate, their increase will lead to credit contraction. Why? Because increase in repo rate will lead to credit contraction, because whenever there will be increase in repo rate, banks will borrow funds from RBI at higher rate, it will lead to credit contraction. And whenever there is increase in reverse repo, it will lead to again credit contraction. Why? Because banks will be inclined to deposit money with RBI, so again it will lead to credit contraction and vice versa. So guys, these are the most important instruments of credit control. I believe that these points are clear. If there is any confusion, feel free to revert me back and kindly give your valuable feedback and review. Happy learning guys.